All right, let's talk about Tesla. It's one of those companies that really feels like it lives in two different worlds at the same time, right? On one hand, you have the story it tells about the future, and on the other, you have the numbers it's reporting right now. We're going to dive right into that gap and try to figure out what's really going on. And the entire debate really comes down to this one question. Is Tesla just a car company hitting a bit of a rough patch? Or is it actually the foundation for our entire AI-driven future? Because how you answer that changes everything about what this company is actually worth. And this really paints the picture, doesn't it? On one side, you have the reality, the cold, hard numbers. Free cash flow, that's the actual cash the business is bringing in the door, is down a staggering 89%. But then, the narrative is bigger and bolder than ever. The goal is to become the most valuable company on the planet. So, which one do you believe? Let's start with the facts. Okay, so for a minute, let's just push the big futuristic story to the side and focus on part one, the evidence. We're just going to look at the raw, unfiltered numbers to see how the business is actually doing, right here, right now. And wow, when you look at the recent performance, it is pretty rough. Revenue, down 12%. Operating profit, that's been sliced by 42%. And that free cash flow number we just talked about, it's basically vanished, down 89%. Look, by any traditional measure, these numbers are screaming that the business is in a tough spot. So you see numbers like that, and you're probably thinking, okay, they must be in some serious financial trouble, right? Well, this is where the story takes a really interesting twist. Because even with that poor performance, Tesla's balance sheet is an absolute fortress. I mean, they have more than double the cash they need to cover their immediate bills, they have very little long-term debt, and they are sitting on a mountain of cash, almost $30 billion. So what that means is, while the car business is struggling, the company itself is financially rock solid, and that gives them the freedom to tell a much, much bigger story. And that mountain of cash is exactly what lets Tesla shift the whole conversation. It lets them move away from today's numbers and get everyone focused on part two, the narrative. This is all about the story of tomorrow, of what Tesla could become. If you listen to the last earnings call, the message from CEO Elon Musk could not have been clearer. He was basically saying, forget about the car sales numbers for a minute. Because for him, the entire future of the company and the reason for its massive valuation all comes down to one single idea: autonomy. And this vision is so much bigger than just your car driving itself. The story they're selling is about a whole network of autonomous robotaxis. It's about Optimist, a humanoid robot that could completely change manufacturing. The goal is audacious. And when you're dreaming that big, today's financial problems, well, they're just dismissed as temporary headwinds. But it's funny, if you listen closely to the company's leadership, it feels like two different songs are playing at the same time. You've got the CEO painting this picture of a world-changing future, and then you have the CFO bringing things back down to earth, warning about very real issues like tariffs, lost tax credits, and production delays. It is the ultimate clash between that long-term vision and the short-term reality. So, that brings us to the verdict. We've got struggling profits, but a balance sheet that's a fortress. We've got a grand vision for the future, but very real challenges today. So how does the market make sense of all this? And maybe more importantly, what's the price it's putting on that dream? Well, the answer really comes down to this one absolutely staggering number. This is Tesla's price-to-earnings ratio. It's just a simple way to see how expensive a stock is. And what it means is that for every single dollar of profit Tesla made last year, the market is willing to pay almost $200 for a piece of the company. And just to see how wild that number is, compare it to other car companies. The Chinese EV giant BYD trades for 16 times its earnings. Ford trades for 10. General Motors is all the way down at 5. The market is sending a message loud and clear. Tesla is not being valued as a car company. It's being valued as a revolutionary AI and robotics company. Okay, so the price is clearly sky high. But that brings us to our final verdict. Could it actually be justified? We can get a clue by looking at what analysts expect to happen over the next couple of years and see if today's price makes any sense at all. So here's the basic math. Analysts pretty much agree that Tesla's earnings are going to drop next year, but then they're expecting a big rebound in 2026. So let's imagine that plays out perfectly. And let's even be generous and say the stock trades at 100 times its earnings, which is its historical average and still way higher than any other car maker. You run those numbers and you get a target price 2 years from now of about $241. Now here is the kicker. If the stock price in 2 years is $241, what does that mean if you buy today? It means that even if that optimistic analyst's forecast is perfect, your investment wouldn't grow. It would actually lose nearly 15% each year. And this really boils down to the investor's dilemma. If you ask, is it a good business today? The numbers say no, profitability is going down. Is the future promising? Oh, absolutely, but it's a huge uncertain bet. And finally, does it offer a good return from this price? The projections suggest not just no, but a potential loss.
You know, legendary investors always talk about buying with a margin of safety, paying a price that's low enough to give you a buffer if things go wrong. But with Tesla, the situation feels completely reversed. The price is so high that it creates the opposite, a margin of danger, where you need everything to go perfectly right just to break even.
And that's really the ultimate question this leaves us with. When you look at the story versus the numbers, are you paying a price that offers you a margin of safety for the future? Or are you paying a price that exposes you to a margin of danger if that future doesn't unfold perfectly?